So, picture this, a future where you're not constantly stressing about money, where you don't have to second-guess every little thing. What's the secret to getting there? Well, according to Nick Maggiulli's book, the answer is way simpler than you think. All right, let's jump in and break down the powerful lessons from Just Keep Buying.
You know, we're always told that investing is this super complicated game, right? Something for Wall Street gurus. But what if that's just wrong? What if the path to building real wealth was actually open to every single one of us right now?
So let's just toss all that out the window. Forget the scary, complicated charts, forget trying to find the next big thing, and for sure, forget the impossible dream of timing the market perfectly. We're going to cut through all that noise and get right to what actually works.
Because believe it or not, building serious wealth over the long haul, it really just boils down to one simple, incredibly powerful rule that you can repeat over and over again.
And that rule is a whole philosophy of just keep buying. Don't think of it like some high-stakes strategy. Nah, think of it more like a habit. It's just something you do, consistently, like paying your rent or buying your groceries.
So what does this actually mean? What are we talking about here? Just keep buying is just the discipline of putting a set amount of money into your investments on a regular schedule, like every single month, whether the market is flying high or totally crashing. See, it's not about being a genius, it's about being consistent no matter what.
Okay, but why is this so important? Why isn't investing just a nice thing to do if you have extra cash? Why is it an absolute must for your future? Well, let's break down the 3 big reasons.
There are 3 really powerful reasons. First, you are literally saving for your future self, the person you're going to be in a few decades. Second, you're fighting back against inflation, which is this silent thief that's eating away at your money every single day. And third, you're turning your work today, your human capital, into financial assets that grow for you tomorrow, even when you're sleeping.
It's kind of hard to connect with future you, right? But check this out. There was this fascinating experiment. When people saw a realistic, digitally aged picture of themselves, saving for the future suddenly became real. It became urgent. And guess what? They started investing more. At its heart, investing is really just an act of kindness to that older version of you.
And this right here perfectly shows that second threat, inflation. With just 5% inflation a year, which is not that high historically, your money's buying power gets literally cut in half in just 14 years. So cash that's just sitting in a bank account isn't safe. It's actively losing value. Investing is your #1 defense against this invisible tax.
Okay, so we get why we have to invest. That's clear. But now for the million-dollar question, right? What exactly are you supposed to be buying? The main goal is to own a mix of things that make money for you. You've got stocks, which are basically tiny pieces of big companies. You've got bonds, where you're kind of like the bank, loaning money to governments or corporations. And you have real estate, including stuff like REITs, which lets you own a piece of big property portfolios. They all have different levels of risk and reward. The key isn't to pick just one. It's to spread your bets across all of them. That's what we call diversification.
Now, you might be thinking, I'll just pick the next big stock, right? We all think that. But hold on. A massive study looked at 90 years of data and found this absolutely staggering fact. A tiny fraction of companies, just 4%, are responsible for basically all of the stock market's gains. The odds of you picking those winners consistently? It's almost 0.
Here's what that looks like. It's wild, isn't it? The overwhelming majority of growth comes from this tiny sliver of superstar companies. Trying to find that needle in the haystack is a losing game for pretty much everyone, even the pros. So, what's the smarter play? Simple. You buy the whole haystack. Instead of trying to pick out a few lottery tickets, you can use these simple tools called low-cost index funds or ETFs. Just think of them as a shopping basket that holds a little piece of hundreds or even thousands of different companies. This way, you are guaranteed to own the big winners without ever having to guess who they're going to be.
Of course, if you buy the whole market, you have to ride its ups and downs. And this brings us to what is, without a doubt, the biggest challenge for any investor, learning to master the emotional chaos when the market goes crazy. Let's do a little thought experiment. Imagine a genie shows up and tells you with 100% certainty that the stock market is going to tank by 40% over the next year. What do? Seriously, what's your gut reaction? Do you sell everything? Do you wait it out? It's a tough one, and it gets right to the heart of our biggest fear. Well, the data on this is crystal clear.
An investor who tried to get clever and avoid even small market dips ended up with 90% less money than someone who just bought and held on for the ride. Why? Because when you try to avoid the downturns, you almost always miss the rocket ship recovery that follows.
Imagine you log into your investment account and you see this, a 50% drop. Your hard-earned money cut in half. Your stomach just plummets, right? It feels like the world is ending. But this is the exact moment where most people make their single biggest mistake, because this number is not the end of the story.
Because here's the simple math we all forget when we're in a panic. If your $100 drops by 50%, you have $50. Now, to get back to your original 100, you don't need a 50% gain, you need a 100% gain on that $50. The climb back up is always steeper than the fall. And for anyone who is buying when things are low, that climb is a massive, massive opportunity.
So here's the key takeaway, the thing you have to burn into your brain. History shows us that the absolute best times to invest are when things look the absolute worst. After a big crash, the odds of making huge returns are stacked way, way in your favor. A crisis isn't a reason to sell, it is the single best reason to buy.
Now, the just keep buying idea doesn't mean you never sell. Of course you sell eventually. It just means you sell for smart, logical reasons, not because you're panicking. So, when is it actually the right time to sell?
Well, one of the main reasons is to rebalance your portfolio. Let's say you start with a 60-40 mix of stocks and safer bonds. Over many years, your stocks are probably going to grow a lot faster. If you do nothing, your portfolio could end up being 95% stocks, which is way more risky than you signed up for. So rebalancing is just selling a little bit of your winners to buy more of the stuff that's lagging behind, getting you back to your original game plan. It's about managing risk, not just chasing returns. And this all brings us back to a piece of wisdom that's literally centuries old. Baron Rothschild made his fortune during the absolute panic of the Battle of Waterloo. He knew that the moment of maximum fear is also the moment of maximum opportunity.
Look, the market is going to recover from whatever the next downturn is. It always does. History tells us it could be a 50% gain or maybe even more. The only real question is, when that happens, will you have been sitting on the sidelines paralyzed by fear, or will you have just kept buying, positioning yourself for that incredible ride back to the top?